In this video, we are going to talk about how to make money with debt, 2021. So before starting this video, please like this video, and subscribe to our channel for the future updates. Debt is a term that many people are apprehensive about hearing. The subject of debt relief is covered extensively in a wide range of television series, novels, and periodicals, among other media. Despite the fact that debt is generally regarded as a negative measure, it may also be a positive one when used properly. The most common approach of using debt to invest positively is to employ leverage to multiply your returns by an order of magnitude greater than 1. What is the definition of leverage? When you borrow money to boost your return on investment, you are said to be employing leverage. In order to attain returns that were previously thought to be impossible, you may need to use leverage, which increases the danger of losing your cash. Defining good and bad debt. It is dependent on a number of criteria whether or not a certain debt is good or bad. There's the interest rate to consider, as well as the length of time it will take you to repay the loan. Then there's the question of what you intend to use the money you've borrowed. Equally crucial is your individual debt tolerance, which should be taken into consideration. Generally speaking, good debt is borrowing that aids in the accumulation of long-term wealth. Bad debt, on the other hand, can have a negative impact on your credit and deplete your financial resources. Risk and cost are the two considerations that make a difference in this situation. Credit card debt is, without a doubt, the most typical type of bad debt to encounter. In the United States, the average credit card amount is $6,000 per person. For this reason, it is considered a form of bad debt due to the exorbitant interest rates charged on the loans. The use of car loans as an example of bad debt is that they are used to borrow money in order to purchase an asset that depreciates in value. Here are the 7 ways to make money with debt, 2021. So let's start. Number 7. Good debt may help you accomplish your objectives. In light of the association between a college degree and increased wages throughout your career, student loans are undoubtedly the most common example of good debt. However, this is only the beginning. Obtaining good debt can assist borrowers in accomplishing a goal or in avoiding a negative outcome, according to Mook. If you're looking to achieve your goals, consider another classic example of good debt: taking out a mortgage to purchase a new home. The majority of people will not be able to pay for a property in full up front. However, even if you were able to pay for your home in one lump sum, there are advantages to going on debt to purchase a house instead. Paying down a mortgage results in increased equity in a home, as well as the possibility of tax benefits. Furthermore, if you are confident in your ability to make your monthly payment, there is the added benefit of raising your credit score as a result of paying payments on time on a frequent basis. Number 6. Using a loan to diversify your investment portfolio. Yet another potentially effective debt technique is the use of a loan to diversify your investment portfolio, which is particularly useful for certain wealthy individuals who have a concentrated stock holding in a single business. In order to diversify their long-term investing plan, they can borrow against their concentrated position and use the funds to purchase stocks in other companies. And further benefit of borrowing against a concentrated stock holding to diversify your portfolio is that you may be able to avoid paying the capital gains tax that would have been due if you had sold the concentrated stock in question. Number 5. Margin investing. Investing on margin enables you to purchase a larger dollar quantity of shares than you actually have the funds to purchase with. A margin account, for example, could be opened if you have $50,000 in your standard brokerage account and wanted to leverage your investment even further. In order to open a margin account, you must deposit a minimum of $50 toward the buying price of a stock. Initially, you would have $50,000 in cash on hand, with an additional $50,000 in loan funds provided by your broker. Your $50,000 investment provides you with purchasing power equal to $100,000. If you wanted to, you could use this money to purchase $100,000 worth of shares. If the stock price rises, you will be able to pay off the loan and keep the profit in your pocket. If your account's equity falls below a specific level, your brokerage firm may issue a margin call, which is a monetary demand for additional funds. If you are unable to meet your margin call because you do not have sufficient funds, your broker may liquidate your whole position in a stock, resulting in you incurring financial losses. Number 4. Leveraged ETFs. Leveraged investment can be a good debt strategy in its own right. Consider the following scenario. You make a $100 investment with an estimated rate of return of 10%. If you put your own money into the investment, you would make $10. However, if you were to invest half of your money and borrow the remaining half, you would be able to earn more money if the interest rate on the loan was less than 10%. According to Mook, in this instance, you leveraged your return. The use of leveraged exchange-traded funds, ETFs, allows investors and traders to increase their returns by taking a position long or short on a specific index. Fund firms such as ProShares offer leveraged exchange-traded funds, ETFs, that allow investors to magnify their earnings and losses by 200% to 300%. These funds allow you to make investments in certain indices, bonds, commodities, or industry sectors, among other things. The exceptional profit potential of leveraged exchange-traded funds, ETFs, makes them appealing. Using leveraged exchange-traded funds, ETFs, during market booms, you can generate profits that most investors only dream of. The difficulty is that the same way leveraged ETFs might work for you, they can also operate against you in the other direction. Because of the high risk of losing money while trading in and out of these funds, leveraged exchange-traded funds, ETFs, can multiply losses by wiping out your entire investment in a matter of days. Number 3. Hedge funds. In the world of financial instruments, hedge funds are among the most heavily leveraged. They are well known for creating astronomical returns through the use of leverage. Many hedge funds use leverage of up to 10 times their total assets to fund their operations. Using leverage, billionaire hedge fund managers such as John Paulson have been able to make ordinary investors into multimillionaires. However, if the fund manager's investment thesis proves to be incorrect, the fund may go out of business, resulting in the loss of all investors' capital. Hedge funds like Long-Term Capital Management, LTCM, which need bailout funding, were leveraged up to 30 times their assets, according to the Financial Times. Number 2. Short selling. Is it possible that you've sat through a financial program on television and heard someone suggest that it's time for you to short the market? It is common practice to gamble against a certain security by borrowing shares from an investor and then selling them in the hopes that the value of the shares will drop in the future. Short sellers have made a fortune by correctly anticipating and capitalizing on stock price falls. The disadvantage of short selling is that losses are virtually limitless, which means that short sellers can lose significantly more money than they initially put in. Number 1. Forex Trading. Forex trading enables investors to control big blocks of currencies with a relatively small sum of money by utilizing leverage. Currency investors have the ability to leverage their accounts 100 to 1. The advantages of currency trading are that you can take a modest bit of money and transform it into large sums of money in a short period of time. George Soros is referred to as the man who broke the Bank of England, because he amassed a $1 billion fortune by wagering against the pound. Currency trading, on the other hand, has the potential to completely deplete a trader's account in a matter of minutes. The fact that debt can allow individuals to make purchases they otherwise would not be able to make goes against conventional wisdom because debt is viewed as a negative force on their finances. However, when used correctly and managed appropriately, debt can allow individuals to make purchases they otherwise would not be able to make, thus increasing their returns significantly. Make use of our free stock simulator to put your trading talents to the test. Compete against thousands of other Investopedia traders and trade your way to the top of the leaderboard. You should practice submitting transactions in a simulated environment before putting your personal money at risk. Practice trading methods so that when you're ready to enter the actual market, you'll have the experience you'll need to be successful in it. What do you think of our list? Which thing do you like from above list? Let me know in the comment section below. If you enjoy this video and want to hear from me again, be sure to hit that subscribe button before you go. Thanks for watching.